Yo, welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today I'm going to be taking you through how to invest £250 or dollars or euros. We're not prejudiced over these sides. It don't really matter. It's about the principles, and the principles can apply wherever you are across the world. Now, many moons ago, I say many moons ago, it feels like many moons ago, it feels like back in the day, I did a video how to invest £100, and it was one of the most popular videos on the channel relative to the views that I get and the videos that I normally traditionally produce on the channel. But one thing I did mention is that I'm gonna be always doing an incremental increase set of videos. So it'll be 250, 500, 1,000, etc, 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 and we'll just keep on going up just like that. So if you want to know how to invest £250, please like, please comment, please subscribe. I'm on a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear, simple, and transparent manner. But first, let's get into this, man. How to invest £250. Now, there's two things that I want to say before I get into the meat of this video. Sorry for all you vegans. Before I get into this eggplant of this video, listen. In the first video, one thing I do mention is that you need to clear your debt. Now, the same thing applies whether it's £100, £250, or 100 large. Listen, if you've got debt, unsecured personal debt, I'm not talking a mortgage, I'm talking about loans, credit cards, overdrafts. If you have some debt that you are paying interest on, that some dude with chinos and brogues in a bank is just cleaning up off your hard-earned money, clear that first. Get that debt out of the equation. That is the primary thing you need to do in all scenarios. I cannot stress that enough. What you will pay in APR and interest on debt will far outweigh what you might make in any savings account or any investment that you might potentially make. Not in 100% of scenarios, but probably in 99.98% of scenarios. So I'm doing this on the proviso that you're debt free, that you've cleared your debt, and if you haven't, that for me is definitely the first thing you should do. Or at least if you're very close to clearing your debt, then obviously hopefully this information will be more beneficial for you. The second thing I want to make extremely clear is that I'm talking about £250 or dollars or euros, we're not prejudiced over these sides, on a regular basis. And what I mean by that is £250 on, say, a monthly basis. Why, you're asking? Well, listen, investing is a lot like the gym, right? So if you, for example, do a nice little bicep workout on January the 1st, 2017, and then you don't do anything, and then the end of December 2019, you're looking at your arms like, why is my arms not grown? You think it's going to remember that little bicep workout you did all 3 years ago. No, you have to regularly do bicep workouts. You have to have a bicep session once or twice a week, every week for the next 3 years, in order to see a material difference. And the same thing is with investing. You need to invest on a regular basis. A little £250 at the beginning of a year, 3 years later, you're not gonna see like 10 grand. That's not how things work. Maybe it might work for some people in Bitcoin or whatever, but that is an outlier. That is definitely the exception, and it's definitely not the rule. So what I will say is that I'm talking about £250 on a regular basis, similar to if you were going to gym on a regular basis. Your only other alternative, to be honest, is to have the bag up front and put the bag in straight away at the beginning. So if you have 5 figures, whatever up front, and you want to invest, then cool, you can do that and see a material return that you're going to be happy with. But if you're starting from scratch, which is what this channel is dedicated towards, then you need to be doing it on a regular basis. So the very first thing in terms of investing £250 or dollars or euro is to get yourself a regular savings account where you can earn up to 5% or hopefully more, depending on what country you're sitting in, on your savings account. Now, again, a lot of this stuff that I tell you, I've done myself. So I've done this myself. So this is not just arbitrary information, and I'm going to try and give you real contextual information about my experiences with doing this so that it can put it into a little bit more context for you. So what you're seeing on your screen now is from Money Savings Expert, and it's telling you different accounts that pay you 5% on an annual basis. Now, wherever you are in the world, whether you're in the US, the Caribbean, whether you're in South America, Europe, Middle East, Asia, Africa, listen, Just take the information as a principle, and obviously apply it to your situation. The banks that you have over in your sides might pay you a higher interest rate, it might pay you a lower interest rate, but generally speaking, the principle might be the same. So get yourself a fixed interest rate saver is what I'm basically referring to, so that the interest rate is not variable, it's fixed, which basically means that if you do a certain thing on a monthly basis, you will get a guaranteed amount of interest at the end of the year. Now, the certain thing you have to do in this scenario is pay £25 to £300 per month, or pay £25 to £250 per month, or again £25 to £250 per month. If you miss a month, you don't get the rate. And usually in the terms and conditions of the actual product, it will tell you that, let's say you missed 1 month, you might get, say, 3%. You missed 2 months, you might get 1%. You missed 3 months, you might get 0.000, shut your mouth and go home. Listen, that is the type of thing that these banks do to us. So you have to be regular and you have to be consistent. It might mean that you might flex the amount, but I'm just going to go on the basis that you've got £250 a month that you can do on a regular basis. Now, my experience, I've done this for many years. I don't do it anymore, just because my financial predicament has changed quite a bit. But earlier on, when I was starting out, I definitely wanted to be disciplined with my savings. So of my salary, I always used to put the very first £250 into a fixed rate savings account. I had mine with Nationwide, which is a building society in the UK, for those of you guys that don't know. And the reason why I did it with them was because my main bank was not with Nationwide, it was with another bank. And so I wanted that a bank account somewhere else that I didn't have, visibility of on a regular basis, that I can just put it away and kind of forget about it. It felt like a bill. And then obviously at the end of the year, I can obviously see the money materialize and, be happy, and then obviously try and repeat that progress. So, my first recommendation is that definitely do that. I think it's a very worthwhile thing to do. You can invest in the stock market and not even earn 5% on an annual basis. It's very, very probable that you might lose 5%, or you might lose 10% or 20%, depending on which stocks you pick. So this is a guaranteed rate of 5%. But to be honest, 5%, great. It's a rate. However, for me, the best benefit of this is the discipline. If you have the regular discipline to do this on a monthly basis, and you don't get, caught up by Instagram and start buying Louboutins, or start going on flights to Magaluf or wherever it is you want to go to, and, stunting on the gram, taking pictures. If you're actually like, no, bun all of that, I'm going to invest my money regularly, diligently, and I'm going to sit at home and eat my shepherd's pie and watch, Dragon's Den or something, then you will reap the benefits over the long term. And that is, for me, the biggest value from doing something like this, is being disciplined, paying yourself first from your salary, and then obviously being rewarded with an interest rate at the end of the year. So the very, very first thing in terms of how to invest £250 is to find a fixed rate savings account that penalizes you, not takes from your money, but takes from your interest, if you don't do it regularly on a monthly basis. Try and keep the account separate to the bank that you're already banking with. That might help you to not think about and see the money, and try and just do it straight out your salary. Have a standing order or something that just set up just to swish it over there, and hopefully it can be beneficial for you. The second thing in terms of how to invest £250 is, I always talk about this, man, investing in yourself. Listen, I can't express how important it is to invest in yourself, and what I genuinely mean by that. And I'm going to take you through some personal examples just so that you can really see the power of it. Now listen, I'm on the site Udemy. There's obviously loads of sites, and actually it doesn't even have to be Udemy or other sites. Investing in yourself could be, books. It could be a whole bunch of stuff. It could be different courses. It could be, doing some work experience in an area that you might want to learn more about. Let's say, for example, you're really into music and you want to go work at a record label for free for a month or something, just to learn how the music industry works. That is a form of investing in yourself. Like, you might spend, say, £200 in travel and food and expenses, but don't see that £200 as a waste. See that £200 as an investment into your potential future. Now, obviously, has to be something that you're interested in. However, there are some scenarios where actually you can invest in courses of an area that you're not directly interested in, but it's going to help you in an area that you are interested in. And I'm going to make that crystal clear in this segment of the video. So on Udemy right now, you can see there's loads of courses in the business section, from, you know, deep learning, A to Z of, that's probably machine learning, MBA, like doing an MBA, machine learning again here, web developing, data science, ethical hacking, you know, introduction to finance, how to become an accountant from scratch, etc., etc. And there's loads of different categories. You've got like design categories, photography categories. And, you know, look at the costs, like $10.99 for the course, which is not a lot of money. You could sit here and do like 50 courses and learn a lot about different areas. And obviously, you know, the star rating is important, because then that can tell you the quality of the course that you're potentially investing in towards, and obviously how much people have done that course and obviously rated it. So just similar to when you're downloading the app from the App Store, it gives you a nice clear picture of, boom, is that a worthwhile course to be investing on a basis. Now, let's say, for example, you are interested in photography and you don't need to do a photography course, but you want to start a photography business of some kind. Or, you know, let's say you want to start a gym, or you want to start a vitamin supplement that you give to Instagram models. Listen, whatever floats your boat, I'm not going to judge. All I'm going to say is that if you want to know how to run a business, there are certain business fundamentals that you might know. And this is the example of me saying you might do a course that you're not directly interested in. However, it can have a knock-on impact that's going to help benefit you in what it is that you are interested in. So as an example, if you might want to run a business, you might need to know a bit about accounting, because within accounting, you're going to need to know about profit and loss. You're going to need to know about cash flow. You're going to need to know about, you know, revenue. You're going to need to know about sales. You're going to need to potentially know how to manage your books, right? And so if you don't know about some of those fundamentals, you might struggle. You might go broke quick. The business might fail. You need to have a little bit of financial knowledge to run a photography business or to run a vitamin business. And if you don't, then you need to bring a partner on board that knows that. One of you two need to. This is the reason why of every company, the top two roles are the CEO and the CFO. That's typically the setup, the top two roles. Why? The CEO is the person that has the vision of the actual business. So that might be the person that says, look, these supplements are the best supplements in the world, and they need to go to all of these Instagram models across the world, and that's how we're going to make our money. Cool. But if you don't know how to manage the production cost of building those supplements, the testing costs, maybe all of the things you might need regulatory licensing in order to sell those supplements, the distribution cost of delivering those supplements to different places in the world, the tax implications, not only in your country, but in different countries along the world, the distribution channels. If you don't know about all of those different types of financial stuff, then actually it's going to become very difficult to achieve your dream in selling supplements to Instagram models across the world. So what I will say is either have someone on board that's going to do that, or invest in courses that's going to let you know how to do accounting, bookkeeping, finance, just so you can manage and pattern that stuff up, you know, extremely well, and you know exactly what you're doing in this space. When I talk from a personal standpoint, I'd probably say over the last 10 years, I've probably done about and I'm not talking about like my degree or university or college or anything like that. I'm talking about, you know, actual professional courses, you know, randomly just outside of outside of like traditional education. I probably spent about $5,000 in courses. Probably, I'd say about $5,000. And the question then becomes, has that money paid itself back? And, you know, my answer is absolutely, probably at a rate of like 17,000%. Like, it helped my earning potential, my earning ability to just skyrocket, to be honest. But I had a plan. I had a plan of, these are the courses I want because these are the jobs I want to get, and this is the career I want to have. And I've been fortunate enough to execute along that plan. So that, for me personally, is the reason why courses can be very, very valuable. You also got to think that a lot of the time, let's say, for example, you might want to do consulting. And let's say, I'm going to just pick a completely random thing I know nothing about. Let's say you want to be a life coach in nutrition, right? You might want to be a life coach in nutrition, but in order to get the credibility and for people to trust your nutritional advice and not to think that you don't know what you're talking about, you might need to do a little nutrition course. Let's just see if there's a nutrition course on here. Like, you might need to do a little nutrition course. And the reason why you'll do that is not to necessarily, like, see, boom, there's loads of nutrition courses. It's not to necessarily say that that course is going to teach you how to do nutrition, but a lot of the time, that's going to help you sell nutrition to the people that you're selling it to, because that's effectively what you're doing. They're going to think you're more credible because you've got these qualifications behind you. And so that little investment in those courses doesn't necessarily help you be better at nutrition, but it helps the people that you're selling to feel more confident in buying nutrition advice from you. So there can be a secondary impact to doing these courses, which has no impact on you directly, but has impact on directly on the people that you're selling to. So, for me, doing courses, learning different things, learning things that's going to help you in starting your own business. I'm all about, empowerment and people to, do their own businesses and have their side hustles. You can absolutely have a regular job. I have a regular job, but I always have different things that I do on the side as well, because eventually, those things will keep you going if something goes wrong with those regular jobs, right? So, invest in yourself, get into those courses, and hopefully that will help you in the long term. The very, very third thing, and I'm going back to the stock market here because this is a stock market channel. Actually, no, this is an investment channel, but the stock market is definitely a key part of this channel. It's probably the main focus of the channel. And on your screen, you can see the S&P 500 over the last 5 years. Now, if you're new to investing, me personally, when I started investing, obviously I knew more about the market because I came from a trading background, right? So because I came from a trading background, I went in and started picking my own stocks. If I knew nothing about trading or nothing about finance, the very, very first thing I'd be investing in is an ETF. For those of you that don't know what an ETF is simply an exchange. It stands for exchange traded fund. And basically, it's a basket of stocks. There are 85,000 stocks that on the world sitting on different exchanges. But what an ETF is that it picks a group of those stocks, whether it's 500, 1,000, etc., and it puts them and wraps them into one bag. And then effectively, you're investing into that bag. So now your £250 investment is spread across all of the stocks that sit within that basket, sit within that bag. Just think of it like you're going to your supermarket. I don't know, you're going to Sainsbury's, Tesco, Walmart, wherever it is that you guys go to, do your grocery shopping. You put your lettuce in, you put your cucumber in, you put your bread into the trolley, you put your milk, me personally, I don't drink cow's milk anyway, so you put your almond milk into the trolley, you go over to the aisle of sweets, you put your Haribo, some chocolate into the trolley, you go to the aisle of, I don't know, drink, you put orange juice, you go to the alcoholic aisle, you put some beer, some wine, some Hennessy, whatever it is you drink. Listen, your basket basically, by the end of the time you're in that supermarket, is full up with a whole bunch of random stuff. That's exactly what an ETF is. All of those random different products in the trolley is going into your house, and that's what you're going to eat and consume. And it's the same thing with an ETF. You're going to eat and consume different bits of stocks from different companies across the world. Now, an ETF can, be like this one you see where it tracks an index, which is just an average, or it can be about a specific country or region, such as like a Japanese bond or something. Or it could even be something like a specific sector like healthcare or clean energy. An ETF can be absolutely anything. So irrespective, I would say try and find an ETF that tracks an index similar to the one you're seeing on your screen. And the most traditionally known one is the S&P 500. And I just think it's something that probably everyone should have in their portfolio. And the reason why is because the trend line is just gradually going up over the last 5 years and will probably continue to do so for the entirety of this, the lifetime of the S&P 500, to be honest. And so if you've got £250, I would incrementally invest into something like the S&P 500 on a regular basis. And that will see realize a much greater growth over the long term. Now, if you see, we're starting from 0% here. Obviously, it's been going on for longer, but I'm only looking at a 5-year period. And over 5 years, it's reached 111%. So that's 111% over 5 years. We can roughly equate that to 22% on average on a yearly basis. And that is a great return. And you don't have to do any work, but keep on buying this stock on a regular basis. And you'll get, it depends on how you buy it. Will you see 111%? But effectively, that might be, say, the average return you might get 20% or something like that, or 10%, depending on how you invest over the course of the 5 years. Now, if you want to see it more visually, I use this compound interest calculator for those of you guys that are new to the channel. So let's just say the initial investment is £250, and let's say you add 3,000 on a yearly basis, which is obviously £250 per month, and let's say you do that over 5 years, and that was 111% over the last 5 years for the S&P 500. Well, I'm going to do say 22% on an annual basis, and we add the interest, let's say 2 times per year, whatever. Calculate that. The blue line is you saving that money into a bank account, or saving it in a bag, in a mattress, under your bed, wherever it is you like to keep your money. And that is basically what you would have over 5 years, 15 grand, because obviously you saved 15 grand. So that's just quick maths, right? But if you put it into something like the S&P 500, that is the green line that you can see right here. And what you can see is actually 28,000. And that's a difference of like 13,500. So, 13,500 over the course of 5 years on average is what, I don't know, like 2,500, so like 2,800, something like that, just shy of 3,000 on a yearly basis or whatever. So that is a lot of profit. You're effectively compounding at a much greater rate, and just by putting it into a vehicle that's going to continuously grow and earn money. So if you've only got £250 to invest, and you don't have any courses that you're really interested in doing, you don't want to put no money into a fixed rate savings account, one, because the interest rate's quite low, or you don't have any that is available around you, or you just can't be asked for it, then I would say if you want to get into the stock market, get something like the S&P 500, invest regularly into the S&P 500, and over the long term, your money will continuously grow. For those of you that don't know what the S&P 500 is, basically the Standard & Poor index of 500 stocks. It includes things like Apple, Microsoft, etc. So it's got a lot of the big name, the big brand stocks that you guys all know about. And all it basically means is that you are getting a share of that stock on a regular basis, where you continue to buy it. Listen, I hope that information made sense, but if it didn't, get in the comments, tell me, you're chatting rubbish, or actually I understand everything, but I want to know more about this, and obviously I'll try my best to reply as quickly as possible. But listen, I hope you found this video useful. If you did, please like, please comment, please subscribe, help the channel grow. I'm trying to get all of this information out to more people in a clear and simple manner. And obviously, if you've got any questions, I'll be there to answer anything that you might need to know. Other than that, take care, have a good weekend or week, depending on when I put this video out. And last but not least, happy investing. Peace.